Welcome back, everyone. I am so incredibly pumped to jump into this explainer with you today. We are doing a deep dive, 15-minute IGCSE exam revision audio overview, and it is specifically built to help you absolutely crush the Accounting 0452 exam. Our main target today, the absolute core architectural requirement for locking in that A-star grade, capital and revenue receipts. This isn't just about shuffling numbers around on a page. It's literally the bridge between basic data entry and high-level financial intelligence. So grab your notes, clear out those distractions, and let's start building your A-star blueprint. Here is our quick roadmap for this explainer. 1. Conceptual foundations. 2. Step-by-step technical execution. 3. Ratio interpretation. And 4. Advanced exam strategy. Let's get right into it.
Section 1. Conceptual Foundations, the 2026 Architecture.
Okay, let's dive into this. To build that perfect A-star response, you absolutely need a flawless foundation, right? And that means mastering the 2026 syllabus terminology. Cambridge has officially transitioned to modern international terminology, so using the exact term heir recoverable debts instead of the old bad debts and owner's equity instead of capital, well, it's no longer optional. It's a mandatory requirement. Flawless accuracy with these definitions is completely non-negotiable if you want those top marks. The examiners are actively looking to see if you are speaking the modern language of accounting.
Now, sitting right at the center of this modern language is this beautifully simple yet entirely unbreakable rule. Assets equal liabilities plus equity. This accounting equation has to be maintained at all times during the fiscal period. Think about it. Every single time you categorize a receipt as either capital or revenue, you are reflecting the duality of that exact transaction. It's the ultimate expression of the business entity concept, essentially proving that the business stands entirely separate from its owner. If your equation is out of balance, well, your whole foundation is cracked.
Building on that foundation requires absolute transparency, and that brings us straight to the prudence principle. I know it is so tempting to overstate profits, but ignoring potential losses, that's a direct violation of prudence. You've got to remember that banks, owners, and tax authorities rely on the absolute integrity of your records to make massive real-world annual decisions. You must also master key vocabulary like accrued, prepaid, realization, and consistency. You'll need to define these terms, sure, but more importantly, you have to actually apply them to the complex, multi-layered business scenarios you're going to face in Paper 2.
Section 2. Step-by-step technical execution, securing the method marks.
So, we've got the concepts locked in, now let's jump straight into the technical trenches. This part is all about securing your method marks. In the exam, even if your final calculation goes slightly off the rails, which happens, your logical flow can completely save you. The procedural flow is basically a journey. It always begins with identifying the correct source document, like an invoice, a credit note, or maybe a bank statement. That document feeds into the books of prime entry, which then populates your ledger accounts. From there, it flows into the trial balance, where we're aiming for 100% accuracy, before making a totally seamless transition into the final financial statements. You absolutely must show all your workings, especially during complex adjustments for depreciation or inventory valuation. You want the examiner to be able to follow your path every single step of the way.
Right in the middle of that procedural flow sits the trusty T account. The T account remains the absolute gold standard for representing the double entry system. But here is where so many students end up stumbling, distinguishing between balance brought down and balance carried down. Balancing these accounts flawlessly is a mechanical skill, and you just have to practice it until it's muscle memory. Honestly, getting this right is what allows the entire rest of the trial balance phase to actually succeed.
Now, what's really interesting about this slide is that it highlights one of the most common mathematical pitfalls in the entire syllabus. I'm talking about the miscalculation of percentages between trade discounts and cash discounts. As a quick refresher, remember that trade discounts happen right at the point of sale, and they typically don't even show up in the double entry records. Cash discounts, on the other hand, happen at the point of payment to encourage prompt settlement. Mixing up how and when to calculate these percentages, that will instantly distort your revenue receipts and cost you some really crucial marks. Seriously, take a mental snapshot of this distinction right now. Section 3. Ratio Interpretation, Mastering AO3 Evaluation. All right, let's move to the next phase of our revision and see how this all builds together. We are elevating from baseline calculation to high-level financial intelligence. Because anyone can be a number cruncher and just plug values into a formula. But what does the result actually mean for the business's liquidity or its profitability? To capture those Assessment Objective 3 evaluation marks, which is truly what separates the A grades from the A stars, you've got to shift your mindset. You're no longer merely recording numbers, you are actively functioning as a financial analyst. Let's look at a practical example of this. Imagine a scenario where a business's current ratio has drastically fallen from a very healthy 2.5 to 1 all the way down to 1.1 to 1. Calculating that drop is just step one. But the AO3 marks? Those are awarded for explaining the why. So the crucial point is unpacking that ratio drop using all the analytical tools at your disposal. If the ratio plummets like that, you need to start asking the high-level questions. Has inventory been wildly overpurchased, which ties up your liquid assets? Are trade payables being settled far too slowly? Or, crucially linking back to our main topic today, have cash reserves been suddenly depleted by massive capital expenditure? Like buying expensive new machinery rather than just covering standard revenue expenses. Analyzing these specific causes is exactly how you secure maximum evaluation marks. But here's the catch. Your analysis can't exist in a vacuum. You will often be asked to perform inter-firm comparisons. The real challenge here is that different businesses use entirely different accounting policies. One firm might use the straight line method of depreciation, while a close competitor uses the reducing balance method. This makes direct apples-to-apples comparisons incredibly tricky. It's almost like comparing a motorcycle to a bicycle just because they both have two wheels. You have to explain to the examiner that these differing policies mean the surface-level numbers don't always tell the whole story. And speaking of not telling the whole story, a true A-star student knows to look way beyond the ledger. You must analyze the quality of the profit by considering unrecorded, non-financial factors. We're talking about things like staff morale, the physical location of the business, and its overall market reputation. These factors aren't captured anywhere in the double-entry accounting records, but wow, do they ever heavily impact the business's long-term sustainability and its return on capital employed. Never, ever forget to mention the human and market elements when you're evaluating a business. Section 4. Advanced Exam Strategy. The examiner's mind. Okay, we've covered the concepts, the techniques, and the analysis. Now, looking straight at the 2024 and 2025 Principal Examiner reports, let's rapid-fire a checklist of absolute do's and don'ts. Because, guys, this is where easy marks just vanish. First, do write legibly in your ledger accounts. Examiners report every single year that poor handwriting makes it literally impossible to award method marks. Second, do manage your time based strictly on question weightage. Please don't spend 20 minutes agonizing over a 3-mark question. And finally, the absolute biggest don't. Do not mix up your revenue and capital items. Misclassifying a capital receipt as a revenue receipt will completely throw off your entire income statement and your statement of financial position. You have to stay incredibly disciplined here. Which brings us to our final thought for this revision explainer. Are you just recording numbers, or are you mastering the ultimate language of business transparency? Mastering capital and revenue receipts isn't some boring chore. It actually empowers you. You aren't just learning how to fill out a ledger for an exam. You are literally learning how to read the financial health of any organization in the world. You are becoming a true financial strategist. So take these foundations, apply the technical steps flawlessly, evaluate exactly like an analyst, and keep those examiner warnings fresh in your mind. You are absolutely ready for this. Keep up the fantastic focused learning.